Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. Got an extra special guest, Queensland-based as well this week, Mr. Simon Pressley, the founder of Propertyology and leading housing market analyst and experts all around the country. Simon, welcome. It's great to have you on.
Hello, Peter. Thank you for having me on.
Yes, really exciting actually, because one of the things that you do a little bit differently from the crowd is you actually you look specifically at the housing market rather than just being a generalist. I think we get a lot of commentary, particularly in the media, where you sort of hear that, the housing market is going to do X, Y, and Z. But of course, there are so many towns and cities all around the country, and I'm sure this will be a popular episode. So before we get on to some of that, tell us a bit about your background and where you grew up.
Grew up as a military child. My father was in the army, so it sort of felt like every 2 to 3 years, Peter, we were relocating to a different corner of the country, not realising it as a young child, but looking back on it on reflection, I think that's helped my ability to be open-minded as a property market analyst, having physically lived in so many different parts of Australia and knowing that beauty is really in the eye of the beholder, whether it's big, small, inland or coastal. Chose the banking and finance path. So in a former life, I specialise on the liability side of the household balance sheet. Still a lot of wonderful learnings there that I use today on the other side of the balance sheet, on the asset purchase side of things. Credit and property always go hand in hand. So understanding credit policy, banking gives you a great appreciation for risk. Naturally, I'm a fairly conservative decision maker. I like to evaluate risks and then I go 100 miles an hour once I feel like I've adequately mitigated them. Chose the property route partly out of falling out of love with banking bureaucracy and wanting to choose a different career path that I was genuinely passionate about. Always had a keen interest in property and commerce, and spent several years literally studying Australian real estate history. Initially, I tried to learn about property markets by doing probably what everyone else does, and that's reading as much material as you can on the internet. And then I realised that most of the people that society put up as an expert actually weren't. That's not a criticism of them. They were generalists, as you said earlier. And I guess some occupation types that I thought you'd learn a lot about how property markets function. I realised that there's actually nowhere in society that you teach that stuff. So I purchased all of CoreLogic's data. So I've got numbers as far back as data takes us on every corner of the country, and spent years studying what actually has happened and, more importantly, the cause and effect. So my role all day, every day, anticipating what might happen in different corners of the country, is looking for the common denominators that the historical evidence has supported.
Yeah, that's fantastic. I've seen some of those CoreLogic spreadsheets, and if you're not a statistically minded person, it's a lot of information, a lot of data, but obviously looking in from the outside, that seems to be what you enjoy doing most, doing the market research. I can imagine for someone like you working in the banking industry with all of the admin and office politics and bureaucracy probably would have driven you mad, I think. But,
absolutely, yeah. I'm a free spirit, entrepreneurial brain, and value efficiency and good decisions. And bureaucratic environments aren't conducive for that sort of personality, mate. If it's common sense or if it's efficient, do it. And it's not what we know banks and governments and that sort of thing for. So,
yeah. Now we'll come on to talk about your analysis of the property market just in a second. So I've got two other questions. Firstly, AFL predictions for the year, because I know you're a keen Brisbane Lions fan, but also obviously you've done some big property purchases personally. What was your first step onto the housing ladder? Those are my two sundry questions.
Okay, housing or AFL first?
Well, let's go with the football first.
Football first. We'll get that out of the way. Look, the heart says Brisbane Lions because as passionate as I am about property markets, Peter, there's nothing I'm more passionate about than AFL. And I'm an absolute rusted on AFL fan. Lions are going well, but this is the most open competition I think we've ever had. Any one of the top 7 could beat each other on the given day. So who's going to win that premiership? It's really going to come down to injuries and suspensions and, confidence at the right time of the year. Hopefully we're on the right side of the ledger with that. So I became a first home buyer at the age of 21. I mentioned earlier, raised as a military child. So mum and dad never bought a house because accommodation was provided as part of dad's employment. But as I entered the workforce myself, I could see that their retirement planning wasn't going to be good. And that was my drive to always not just own a family home, but, be financially independent. I think my first investment property was late 20s. I often criticise myself for my first property investment decision, remembering how confident I was that I had Colonel Sanders' secret herbs and spices and discovered, the secret to property markets. And it did really well the first 2 years. It was a 2-bedroom apartment on the water at Caloundra. And I mistakenly thought that water makes properties grow. And it was false confidence because it went nuts the first 2 years. I thought, I knew it. And then the next 2 years, I lost all that growth. So I'm then left scratching my head going, geez, I can't be anywhere near as smart as what I thought I was. But it's things like that actually make you much more educated. In my case, as a property professional, but in any walk of life, I think moments of adversity and things that happen to us that we don't like, if we actually take time to reflect on the original decision and how we got to a point in our life that we don't like, there's no better learning experience. You can't learn that on Google or in a university degree. So that one transaction, I guess, became an extra driving force to understand, well, why did it grow in the first 2 years and why did it lose so much value in the following 2 years?
Yeah, I guess there's a few interesting themes there. I think I've mentioned on one of these podcasts before, I used to move around a lot as a kid because my dad used to change jobs. He wasn't military, he was in the public sector, but
right.
It does give you a different perspective because I was born in a city, but then we lived regionally as well. And I guess it gives you some different perspectives. One of the things that with my parents was because they actually were on the housing ladder, I guess it was the only sort of big investment they ever made, and it got me to look at property as a way to go. I think on the first property purchase thing, it's interesting, isn't it? Because you think when you're younger, you know everything because you read around a bit, but sometimes there's a lot of things, like you said, with the if it's near the water, it must be a good investment. There's a lot of those things that they're sort of said very often, but they can sometimes be myths. And then I suppose the other thing that's very common is if your first experience is really good for the first year or two, then you think you know everything. And it's like when the first time you go to the casino, the worst thing that can happen is if you clean up because you don't learn any lessons. And often in business and in investing, it's actually from the things that don't go perfectly, that's where you actually get the biggest lessons. So obviously you've had decades, I guess, now of experience of Australian property. So where do you even start if you're analysing for a place to invest? Do you start at the state level as a top-down approach and then work down, or do you just look around all of the individual towns and cities? Where do you even start out?
Oh, big question, mate. Well, I guess, I've got all those years behind me. So I've got that many spreadsheets and programs and just years and years of infrastructure that you've built at your disposal. So that now I develop daily habits, I guess, to gather the current day information and then filter that into the existing foundational information. But some of it's in numbers. We were talking earlier about core logic. It's a minefield of numbers, but they're property specific numbers. And everything's useful and everything has some value, but the property specific numbers is most of the metrics in, say, the core logic data is a reflection of what's already happened. So most of that doesn't give you an appreciation of what might happen. As an investor, you need to be more focused on what might happen next as opposed to what happened, yesterday or last year. So the most useful information to me, and certainly the biggest consuming of my time, is economic information. Now, some of that's in numbers, but most of it is in text. Dozens, probably hundreds of publications that I subscribe to and consume each day. But really what I'm looking for is decisions, announcements, proposals that one way or another are going to affect jobs, job loss or job creation. So it can be, commentary around different industry sectors. It can be federal government policy, state government, local government, big business, small business, infrastructure projects, commodity prices, a whole bunch of stuff. And I'm looking at it through the job creation, job loss lens, and then bringing that right down to an individual town or city level. When we've got it doesn't matter where it is in Australia, but if we've got a town or city and there's a big body of information that gives us confidence that in years ahead, the economy is going to be significantly better than what it is now, that to me is the leading sign for future housing demand. Wherever there's a job, there's demand for housing. If you're going to have more jobs in future, you're going to have not only more demand for housing, but you're going to have more confidence in the community, greater financial capacity in the community, and all those things mean more buyers. More buyers is competition, and competition is where price growth comes from. So the origination for everything is a decision about a job.
I mean, I've seen you say somewhere else before that it can be phenomenally complex analysing a housing market because, as you mentioned, there's almost infinite inputs into the outcome. And, you could look at things like, I don't know, car sales or planned infrastructure and job gains. As you said, a lot of the information is kind of backward looking that, a lot of stuff you see reported, this suburb is, seeing price growth of whatever over 20 years, but it's more the next 20 years that we're interested in, I guess. And I think one of the things, with all of the financial markets in turmoil around the world at the moment, one of the things that just strikes me is that people have just been paying the wrong price for stuff. You look at in the tech sector, there's all these companies that people were paying, it's valued at 50 billion and so on. But in the end, if you pay the wrong price for the asset, that's just, it's not going to work as an investment. And I don't know, I guess one of the key metrics you would always look at is affordability. And if somebody's going to buy a house in a regional city, it's got to be affordable to the buyers now and in the future. Is that one of the key metrics that you would look at?
Affordability is certainly one of our criteria, used mostly to eliminate which locations we won't invest in. We break Australia up very similar to a stockbroker looking at the companies on the stock exchange. So to me, the equivalent of my companies on the stock exchange, if you like, is 8 capital cities and 200 individual regional towns or cities. There's roughly 400 individual regional towns and cities across Australia, but only 200 of what I call communities of substance. So a population of 10,000 or more and a proper economy. So we start with those 200 plus our 8 capital cities, and we've got to start somewhere to eliminate. So I call it the golden rule of all financial decisions, not just investing in property, but in business or anything. Never, ever place all your eggs in the one basket. We eliminate all locations in Australia where, relative to the rest of the country, the cost of that stereotypical detached house is very expensive. So that's got nothing to do with the outlook of those particular property markets. But now and never, we will never invest in places like Sydney, Melbourne, Canberra, Geelong, Newcastle, Wollongong, a number of other smaller regions, the Noosas, the Byron Bays, where it's just really expensive. So there will always be times when their outlook will be really exciting and we'll be aware of that. But we won't invest there because it won't always be like that. So it's a bit like the share investor having 100 grand and putting it all on one stock. They'd break that up. So we will have a client that says, Simon, I want to invest in Propertyology and I've got whatever, $2 million. Great. But I'm never going to spend $2 million of my own money on one property asset. I'm going to break that up into smaller parcels, not only buy multiple properties with it, but strategically pick different towns and cities in different states in the same way that the share investor is going to construct their share portfolio.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, We can lock in highly competitive prices. Plus, our national network of buyers agents are some of the best in the business. So get the buyer's advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
When it comes to real estate investing, that's more important, especially if you're borrowing, because you can easily get very top heavy in real estate. A lot of people who are portfolio investors, that's going to be the bulk of their wealth. And if you are borrowing to invest, well, you could end up with just one or two properties, and you're staking a lot then on an outcome from just one investment. I guess if you go down to the more affordable end of the market, it's more liquid. There's more buyers typically.
Yep.
So if you had, for example, a $1 million budget, would you look at something like, say, 2 500K properties, or would you even split it down further?
Asking me that question today, the answer is one. But if you asked me that same question 2 years ago, definitely the $1 million would have been spread across two assets. But given the phenomenal rates of growth that this country's seen over the last 2 years, those same two properties that 2 years ago, you would have paid $500,000 each for, today might be, depending which part of Australia we're in, but it could be worth $750,000 or $800,000. But the principle of what you're saying is always been key to our strategy. With so many locations across Australia, 200 places to choose from, the evidence has proven to us overwhelmingly that every single year the best performed property markets are among the 200 regions, not among the 8 capital cities. There'll be different locations, of course, every single year. So we want to take advantage of all those opportunities. We want to expect that there'll be downturns down the track. No one wants that to happen, but you and I and no one else can control it. So build a strategy expecting the worst. So that's why we want to spread our assets across multiple locations in the event that the unexpected happens. But it's also preserving cash flow. The one property that we pay $2 million for compared to 3 properties that we collectively pay $2 million for, the investor's cash flow is going to be much, much stronger across the 3 smaller properties rather than the one property. Now, some investors might go, well, I don't care about cash flow, Simon. I'm a high income earner. Well, what if you're not down the track? And even if you are, the bank is never going to assess things the way you manage your household budget. They're required by law to sensitise interest rates, and that's being responsible. So, we need to always be thinking that one step ahead. You might be able to afford it today. You might get the loan approved today. But if in 2 or 3 years' time you're looking to add to your portfolio, you think you can afford it, but the bank says we're not approving the loan for you.
Yeah, it's one of the things we talked about when we caught up for coffee, I think in New Farm or somewhere. You said that quite often you find that the yield on the types of properties you're buying, it might just fall around the 5% level, not because you're chasing the yield per se. It's just, when you get sort of a balanced market in regional Australia, you might get a solid yield around that level. And yes, it might have changed a little bit over the last year or two, but the principle applies. And I know in my case, like now I'm 45, I'm starting to think a bit more about cash flow because I'm thinking, well, at some point I'm not going to be working any longer, and then the super comes into the equation. And you don't necessarily at that stage in the journey, you don't want properties where you're forking out hundreds of dollars every month to top up the mortgage. So look, I guess everyone's been talking about the last 2 years, and let's not talk about COVID policies. We'll probably end up blowing up the internet. But obviously, the pandemic has changed living habits a lot. There's been more remote work, more flexible work. I was basically forced to be based overseas for a period of time, but the world kept turning through Zoom and Skype meetings. And I guess this is fed into a real regional renaissance. I mean, it was a trend that was happening anyway, that people were sort of moving regionally, including myself up in Noosa, but it really sort of accelerated a lot of those trends, almost forced people, and there were, COVID refugees up on the Sunshine Coast. So what are the big property market trends you're seeing or interested in right now? I was in Brisbane last week and the traffic was phenomenally bad. So I guess there may be maybe a hybrid model going forward where some people are city-based, at least for some of the time, but the regions have really taken off?
Yeah, that's one thing I promised myself when we all went into that national lockdown, a bit over 2 years ago. I said to myself, Simon, be more alert than ever. You don't know what, but given how the world, there'll be some major structural changes here. Be alert to try to see those unfolding, because they're about to happen. And now with the benefit of the last 2 and a bit years, there definitely is evidence to support a couple of major structural changes. I think one is we've replaced the urge that some people had to live in a particular place with space. So there's a surge for about 15, 20 years. A lot of people are relocating to the traditional inner city apartment. They probably worked in the city and they were very much attracted to walk downstairs, grab a coffee, go to breakfast, walk to work. That was a trend, say 20 years ago. COVID has just completely flipped that on its head. A lot of those jobs aren't in the city anymore. Either the business doesn't exist, or the job is in the burbs, or the person who had no choice other than to work from a laptop rather than going into the office has got used to that. Their employer might have got used to that and said, actually, we're going to continue doing this even though the COVID restrictions are gone. We didn't like being coped up. Human beings don't like being told you can't do something. We see it in children all the time, but adults are the same. When you're used to doing something and you want to do something and someone says you can't do it, you want to do it more. You like to have that freedom. So being cooped up in, say, a 2 or 3 bedroom apartment was originally attractive to you because you could go walk to work and do those things we talked about earlier. But being told you can't leave it, a lot of humans are going, I just don't like this anymore. I want space. So now space for some people is your good example, Peter. Someone selling their home from the capital city and moving to somewhere in regional Australia. But others are still living in the same city, but they might have upgraded their house. So they've taken advantage of the equity they've had there. So there's more cash in Australian households now than ever. That's a fact. The RBA says we've got over $100 billion in mortgage offset accounts and redraws. So some people have sort of gone, I'm adopting this work from home thing. I like the extra freedom. I've got more time in my day because I'm not commuting. I'm less stressed. But I'm spending more time in my home. I want a nicer home. So I'm spending more time here. I want a swimming pool. I want a better outdoor entertaining area. I want a soundproof room to do these sort of things like you and I are doing. So whether they've renovated their existing home or whether they've sold that existing home and just upgraded to something nicer. So there's some major changes. It changed some economies as well. A lot of service-based industries that were the stereotypical office in the city might not be there now. Now it's not just that office business that's gone. The retail businesses on the ground level, the cafes and the restaurants and the clothing outlets, they don't have as much foot traffic coming in now. Now either those businesses are gone forever, or in some cases they've relocated out into suburbia.
Yeah, it's been a heck of a 2 years. Actually, it's interesting you mentioned being on high alert, because if you went back, and this is what the RBA governor was saying yesterday, I think a lot of people are saying, the Reserve Bank should have done X, Y, and Z. It's easy to forget that in March and April 2020, we were facing economic Armageddon with all the lockdowns. There was forecast of 15% unemployment, all kinds of modelling showing what might happen with the virus. Most of it, thankfully, didn't occur. But you fast forward to today, we've got the lowest unemployment in 50 years, record high employment. There's 250 billion knocking around in excess household savings. As you mentioned, a lot of people have stuck it in mortgage offsets. Now, there's always doom and gloom in the media, but it's really gone into overdrive the last few weeks. The prospect of interest rates going up, the stock market's down a bit. And I've seen over the years with your trademark colourful language, you're not always in agreement with some of the commentary. But how do you see Australia's prospects over the next, say, 10 or 20 years? And how do you see the outlook for things like population growth and the economy in Australia?
Well, it's a big question. I don't allow myself to think 10, 20 years. I've seen the last 2 years of all the change most of us never would have expected is enough. So, the interest rate stuff, you're right. Something you said earlier, there will always be something, won't there, that, the property market, there's literally dozens of factors that influence it. So there's never, ever going to be a moment in time when every single one of those dozens of influencing factors are all trending in the direction we want them to. It will never, ever happen. But human nature tends to be that we focus on the couple of things that aren't trending in the direction we want. And in one of the downsides of the digital world that we live in is that we're consuming so much more information now. We can never put our device down, but it's poor quality information. So we're reading the same negative crap hour after hour after hour, and then humans tend to believe it because it was like, well, everyone's saying it's unanimous. Everyone was saying that closing the international border meant no population growth, so therefore property prices would decline by 30%. Well, that never happened. Then they said, the end of JobKeeper will cause a property market crash. Well, that never happened. Then they said that the end of the loan deferral schemes will result in a property market crash. Well, that never happened. And now they're saying that interest rates going from 0 to a 15th above 0 will cause a property market crash. Well, that won't happen either. I think our ancestors will be looking down upon us, Peter, embarrassed, ashamed, and going, things have never been better. Interest rates are going up from nothing to a bit above nothing, and you're whinging and you're moaning and you're saying you won't be able to afford it. I think what will happen is the RBA will end up settling with interest rates somewhere near where they started out in 2019, somewhere around there. Now, when will they reach that point? I don't know. They surprised me. Obviously, they started raising rates quicker than we all anticipated, but they'll let it change their mind. The world changed. And I certainly didn't expect 2 consecutive months and the most recent one being 0.5% increase. That suggests to me they're in a hurry. Having a couple of weeks to think about that, I think that's good because we've become spooked, not you and I, but the masses have become spooked because interest rates have gone up. Now, we shouldn't be surprised and we actually shouldn't be disappointed they're going up. They're going up because the economy's strong and sensible governing is to get the cash rate back to a level that whenever the next moment of adversity is, it might be a decade away, who knows, we've got a lever to pull. If rates are at 0, you've lost that lever. So the fact that the RBA have got confidence to increase rates now, we should be going, awesome. We've got a full house for jobs. So we should be focusing on that positive and going, interest rates going up, they're just going to get back to where they were. I could afford my mortgage 3 years ago. I'm still going to afford it now. Yeah, so look, I mean, most people with a mortgage have not increased their debt at all over the last couple of years. In fact, a high percentage of them have less debt now than beforehand. But those in the last couple of years who've taken on debt, a first home buyer or someone upgrading their house, for example, they've had to jump through, I would argue, the tightest credit policy in the entire world. For a bank to approve their credit application, they're assessed on, let's say it was 2.5% interest rate or something like that the bank were offering them. They had to prove to the bank that they could afford 5.5%. So effectively 12 interest rate rises of 0.25% each. So there is going to be no widespread reporting of mass sales because people can't afford their mortgage because interest rates have increased. There is not going to be a sharp spike in mortgage arrears because we've got so much cash and so much equity and every person's job is secure. Like, this is literally the best conditions economically, property-wise, that I think every living Australian has ever experienced, literally. All the RBA are doing is responsibly getting the cash rate back to a level. I think, Peter, will end up somewhere similar to where it was about 3 years ago. How quickly it gets there, it's anyone's guess. They appear to be in a hurry, given their decision over the last 2 months. And given a bit of time to think about that, if that's what their strategy is, I reckon that's great because it's obvious that people have become spooked. I find it laughable that they've become spooked, but that's what they've done. So if that's what they're going to do, then the quicker we get the interest rate rises out of the way, the better. What I think then will happen, Peter, is people will realise there was nothing to worry about. You'll see a quick increase in buyer activity. And they will be yet again confronted by a very limited supply pool, either supply to rent or supply to buy. So we'll have pressure and lots of it within a, maybe 12-month period of time. The exception, Sydney and Melbourne, we've said consistently throughout the last 2 years of COVID, they have the weakest property market fundamentals in all of Australia. Every capital city, every region, they have the weakest property market fundamentals, and their property prices are now declining. They're not plummeting. It's nothing to be really scared about, but they are declining. Not because of the interest rates, because their supply pool is back to equilibrium. It's tight elsewhere in Australia, and their economy has been more adversely affected by the COVID lockdowns than the rest of Australia.
Yeah, no, it's interesting you mentioned the stock levels there, because that's the one thing, as you mentioned, the Reserve Bank is going to increase interest rates, but that's partly because, as the NAB survey showed today at the time of recording, that's because incomes are now actually rising quite sharply. So mortgage stress, I mean, I've being British, I've seen a couple of big downturns, and that's when people can't find a job. But at the moment, we've got unemployment at, 3.8% or thereabouts, and 400,000 job vacancies. There's literally a job for every single person. In fact, we went to the cafe today, and the waiter asked if anyone needed a job because there's just so many vacancies around. So it's very hard to see forced sales. The thing I was just doing some research for this interview, and I was looking at the number of properties for sale around regional Australia is unbelievably low. So I just can't see, people are talking about property downturns for sure in the premium priced areas of Sydney and Melbourne. That's already happened, driven by sentiment, but I just can't see how prices are going to drop much in the many parts of regional Australia. So tell us a bit about what you do at Propertyology and what your day looks like, and how do you help clients to go about achieving their goals?
We're the property investors equivalent of the stockbroker, I suppose. Sure, I live in Brisbane, but Brisbane's not my property market. My property market is 8 capital cities and 200 regions of substance. I've got no bias or vested interest in any of those markets. Regardless of where our individual clients personally live, we don't care about that. Our job is to use our intelligence and to provide professional guidance in, firstly, which part of Australia we feel that they should invest in, and provide them with research supporting that recommendation. And then our buyers agents get their hands dirty and physically handpick an individual property and do as all good buyers agents do, then go into negotiation mode and get the best possible outcome for the buyer. Yeah,
one of the things that I like about that is that there's no bias, because I guess in real estate, because it's a commission-driven industry, there's often advice out there, and we've talked about this many times, particularly selling off the plan properties where there's no independent advice at all. It's all driven by the ability to get a commission. But you guys, because you can buy in any state, you can buy in Tasmania or Queensland or other parts of the country, so there's no vested interest or bias in terms of where you choose. It's purely driven on what's best for the client. So if people want to find out more about some of your market research reports or what you guys do at Propertyology, where should they go for more?
Thank you. Propertyology.com.au. Yeah, very simple. 2 things there. If you go to the top menu tab, if you click on the Contact Us section, scroll down there, and if you wish to, there's an area that you can subscribe. We don't charge for our research reports, but I personally will author usually 2 or 3 research reports per month. So anyone who's subscribed via our website there gets that. They will never receive any salesy material from us. It's just good quality information. If you want to know more about our services, the Insights tab has got lots of past reports and blogs that you can consume to form your own educated opinion about our knowledge of property markets, and then contact us direct from there. What we see a lot of is, as people become aware of us the first time, Peter, they subscribe, they follow us on social media platforms or whatever, they get familiar with us and comfortable with us over a period of time, and then when they're ready to invest, we hear from them then.
Superb. So check it out, Propertyology website. And at the time of recording, it's mid-June and Brisbane are flying high on the ladder, but I see the Swannies are still lurking in the top 8. And actually, as you said, it's extremely tight this year. There's so many clubs within 2 wins at the top of the ladder. So we'll have to check in with you later in the year to see if Brisbane can take out the premiership. So thank you so much for joining, Simon, and look forward to speaking again soon.
My pleasure. Thanks, Peter. Have a good day.
Cheers.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.